Back with closing trades right here in ET Now, and we've got Ashi Anand joining in on the show right now to tell us about how the year ahead is going to look like. Ashi, hi, afternoon. Good to have you on ET Now. Ashi, I guess the whole debate is about whether or not small and mid caps will make a comeback come 2026. What's your opinion?
Yeah, sure. So actually, that is quite interesting. I think for small and mid caps to kind of come back, you first need the overall markets to come back. You need momentum in the economy and corporate earnings. I think so. That's actually the first kind of level. Now, that is something which I think people are hoping to start seeing from the current kind of quarter season itself. So, as the kind of result season spans out, there are various different sectors where people are kind of watching for signs in terms of an earnings recovery. Now, depending on how the earnings recovery starts getting baked in, you should start to see an overall recovery in the markets. One other key element for markets to overall recover is some kind of clarity around what's happening on the US-India trade deal. Now, the way we kind of look at small and mid caps is you first need momentum of the overall economy, corporate earnings to come back, momentum back in the overall markets. And as you get confidence there, that is kind of when you will start to see momentum in small and mid caps. I think expecting to see small and mid caps recovering without clarity around this overall corporate earnings recovery, that is probably unlikely. So we would kind of probably expect broader markets, the large caps to continue to kind of outperform broader markets probably over the next quarter or two. But as you get greater confidence on the earnings recovery is when small and mid caps should start to participate.
Okay, so that's the take on what the portfolio construct in terms of where the bias lies in terms of the large caps and the smaller and the mid cap end of the basket. So that's the take coming over there. Actually, overall, the market momentum, we've been absolutely lackluster and, struggling to hold around the 26,000 mark. Just in terms of momentum, do you believe 2026 could have a faster pace in the way the index changes in either direction? But do you think the pace that we're seeing in the market could quicken up next year?
So one, yes, we definitely hope so. And in fact, we're fairly confident that the momentum of the markets in 2026 would actually be kind of upwards. This is kind of driven by, it's to understand what has led to this kind of weakness in 2025. You've kind of come off a couple of years of very strong market performance, and the economy was firing, corporate earnings was very strong. There weren't any uncertainties around at least the US-India kind of trade. These uncertainties were not there. Now, what you have kind of really been battling through most of 2025 is a slowdown both in economic growth as well as corporate earnings. Now, as that has kind of slowed down, given the fact that markets had already moved up quite substantially, there was a need for the markets to take a breather, and that's what you've effectively seen through 2025. You are starting to see initial signs of the economy starting to turn around. There have been various measures that have been put in place over the last 6 to 9 months. It would have started from income tax cuts in the lower tax slabs, GST rationalization, the cut in interest rates. All of these kind of come together to kind of lay a fairly strong foundation for consumption to come back. You also have kind of the banking sector, which has been impacted by NIM pressure, by asset quality pains. A lot of these seem to have bottomed out. So as you're kind of getting into 2026, there are clear signs of parts of the market which were under strain starting to kind of come back.
We've got Ashi on a patchy line, but just addressing the flash that we were seeing on the bottom of the screen right now, it's Fusion Finance. The fundraising announcement has come along the lines where we were expecting to see the board has approved an issuance of 2,000 crores via debt, so that's via non-convertible debentures. And this also includes a green shoe option of 50 crore rupees. Let's pull up the stock, a little spike. We'll give that news some time to settle for the stock. But Kunal, any view on Fusion Finance right now? 158 is where the stock is at.
I don't track anything else.
Okay, no worries. So that's the news that we're getting on Fusion Finance. But Kunal, earlier in the show, we were talking about Honasa Consumer and the block deal that we've seen on the show, 18.5 lakh shares changing hands of Honasa Consumer. And in fact, as we speak, there's a block deal on ITC. It's a massive one. 4.5 crore shares have traded hands in ITC. Kunal, a quick chat check on both these names, Honasa and ITC.
Yeah, so I think both of these stocks are still struggling. Honasa, for example, at 270 to 72 where it's trading right now. There is in fact, a bearish crossover, where the 50 DMA is about to cross over on the downside, the 200 moving average. That I believe could probably act as more of a corrective phase for the stock. So even if the stock has bounced back from the recent lows of 250 thereabouts towards 270 plus where it's trading right now, but I believe that with the pressure of this bearish crossover, the stock may go into a retest of the previous lows around the 250 to 55 mark. ITC on the other hand, in fact, we are starting to see some respite coming back into many of these FMCG names, and FMCG as an overall index has underperformed in the last many months of this market move, where we've seen underperforming sectors trying to make a comeback, but FMCG stocks have not made a comeback for themselves. But there seems to be some bit of sign where many of these FMCG names are seeing price volume action. ITC I think could be a case in point over there. The stock is still trading around just around that 400 levels broadly. So I believe that if the FMCG index manages to pick up, then I believe ITC can also try and come back towards the midpoint of the trading range, which could be around 420 to 450 mark for the stock.
Okay, that's that on ITC, seeing a sizable block deal over there. But in the meantime, let's also take stock of what's happening in IRFC, and it's been in focus after it was provided a 9,821 crore rupee loan to the Dedicated Freight Corridor Corporation of India to refinance its debt taken from the World Bank. Now, earlier we spoke with Manoj Kumar Dubey, the CEO and CMD at IRFC, and here's what he had to tell us.
Rupee sliding and dollars getting dearer, these loans were getting very costlier for them. So we pitched in, and this is one of its very unique kind of deal where every stakeholder was very happy. World Bank was very happy getting it refinanced through us so that they can use this money to other projects in the country. And as DFCCIL has already come out with the information that they will be saving in tune of around 2,700 crores throughout the tenure of the loans. And at IRFC, this is a disbursement that we have done the very same day when the agreement was signed. And this is going to give us a lot of impetus in terms of our NIM, AUM, as well as the margin. Guidance right in the beginning of the FY for around 30,000 crore of disbursement and around 60,000 crore of signing of the agreements and sanction of the projects. We are well on the course. You have seen our Q2 results up to H1, I believe. And when we are closing on our Q3, the way things are going on, the way we have already informed the exchanges, we are nearing completing our target of sanctioning of the estimates and signing of the agreements. And on disbursement also, on pro rata basis, we should be completing or going ahead of the 3-quarter targets.
Ashi, you've been tracking this space very closely. Give us a sense of what effect are you expecting to see on your portfolio of the existing quick commerce giants once Zepto also formally lists. So what's the impact that you're expecting on the existing players in terms of their financials, operations, and most importantly, their market share?
Sure. So the Zepto IPO is definitely going to be very interesting and very closely watched. I think firstly, in terms of our own portfolio, we would be monitoring it quite closely to kind of understand as more details come out as they get closer to the IPO. In terms of just understanding what are the valuations that's going to be coming in. It is very, very interesting because unlike an Eternal or a Swiggy, where you have two businesses, food delivery and quick commerce, a quick commerce at this point in time clearly seems the faster growing business. However, food delivery is a business which has matured a lot more, and I think competitive dynamics are a lot clearer in terms of who the eventual winners are. So in terms of, I think, interest in Zepto as a company, it is going to be fairly high, and we're going to be evaluating it quite closely. And I think without any doubt, quick commerce is possibly the most interesting land grab or the most interesting kind of sector which is out there currently. You have the sheer amount of kind of traditional commerce and e-commerce that has the potential to move towards quick commerce. The overall opportunity size is so large that we believe that over the next year or 2 years, you're still going to be in a fairly highly competitive environment. Now, obviously, Zepto going out and raising funds does actually give them the firepower to kind of continue to be aggressive in terms of competition. both Eternal and Swiggy have decent amount of cash on their balance sheets. And you also have kind of the Amazons and the Flipkarts and various other players also coming in. Our view on quick commerce is that this space is going to be very competitive in the near term. We, unlike other market participants who kind of focus in terms of how quickly our losses will bottom out, we think it is more important that companies continue to invest, continue to kind of grow even at the cost of short-term profitability, because it is very important to ensure that you're one of the top 2 or 3 winners in the space 5, 6 years down the line. So now within all of that kind of, I think Zepto, Swiggy, Eternal, all of these companies have a clear right to win in quick commerce. All of these are interesting opportunities. In terms of our own portfolio positioning, it'll really be a question of relative valuations. And Zepto, a lot of numbers aren't yet out. As some of those numbers come in, it'll be a bit clearer.
Interesting. Kunal, how are the charts of Zomato as well as Swiggy stacked up?
See, I believe at current levels, 285 thereabouts for Eternal, I think it's a good zone where the stock seems to have consolidated. It's come back towards the longer term moving averages. The major correction which started off at around 360 odd mark from those levels for Eternal. So that 20% odd correction is now behind. We're looking at the stock just about grinding through a more of a range over here at the 280 odd levels. And I think at current juncture, I would believe that the risk reward is extremely positive for investors as well as longer term traders to go for a buy. Swiggy, on the other hand, the stock had a bit of a momentum as well as a volume push. I think a couple of weeks back when the stock moved past closer to that 410, 420 levels. But again, with the stock coming back to that 400-ish kind of a zone, indicates that this range is more of a consolidative range for Swiggy. So would not be bullish on the stock at current levels. But yeah, I think about 420 levels is where I would expect a breakout. But for Eternal, I think at 280 levels, there seems to be a very strong evidence that indicators are entering into an oversold territory. So the risk reward is positive to enter the stock at current zone.
And is that the view you have for Nykaa as well on the charts, Kunal? A 60% uptick on a year-to-date basis. More legs to that rally?
Absolutely, yes. In fact, 4 consecutive quarters for the stock from 150 to 250 to 75. Just closer to that 270 levels when Nykaa had hit that kind of a zone. The daily as well as the weekly indicators were into a overbought territory, and then you saw the stock cooling off a little bit, trying to go into a consolidation. Maybe over the next 1 or 2 months, you might expect that the stock may just about hang around to this 250 range plus minus 10 odd points for the stock. But then the trend which has started off 4 quarters back for Nykaa from those 150 levels indicates that we are looking at this as a multi-year uptrend for the stock.
Okay, that's 258, and that's where Nykaa is currently in trade. Ashi, where amidst the entire pool of the new age tech companies are you finding favorites? And let's keep the QCOM and food delivery names outside of the list. We just discussed those.
Yeah, sure. So actually, firstly, we kind of like the overall space. And I think the view is that you are seeing a big value migration away from traditional commerce towards new age digital kind of commerce. Now, within that, there are obviously multiple pockets. And the way we like to look at a fund is that we actually buying the fastest growing companies in a fairly wide range of different sectors. So obviously, food delivery and quick commerce, which you've discussed, is very attractive. But the second space, which is extremely kind of large, and we see a lot of value being created there, is the overall fintech / wealth tech space. So someone like Paytm, someone like Policy Bazaar, various other new companies that are expected to be listed. There is a very large potential for kind of delivery of financial services towards segments of the population that were previously kind of unbanked or under kind of service from traditional finance firms. And new age digital platforms really make service delivery significantly easier. We see a lot of kind of optionality on some of these platforms. Companies like a Paytm, which has traditionally been a payments business, you'll actually see it kind of morph into a much larger financial services firm. And you see this for other kind of companies as well. So I think fintech, wealth tech is something which clearly is very interesting. The other segment is kind of, horizontal commerce. We've just discussed Nykaa now. I think Nykaa is a great example of this overall trend that we're talking about. Consumption has been weak, and consumption has been weak for the last year and a half. But if you look at Nykaa's numbers, they've consistently been growing. And that is reflective of the fact that not just is BPC as a segment fairly attractive, but the sheer shift that is happening away from traditional forms of consumption towards online. So both kind of vertical commerce as well as kind of other e-commerce plays, Meesho has recently gotten listed. That also is kind of fairly interesting. So we kind of see interesting spaces there. There are some interesting smaller bets. Online gaming in India potentially has a very long way to kind of play through. There are certain other interesting niche opportunities in B2B classifieds, various forms of classifieds, etc. So there are multiple different segments. All of them are looking quite attractive. What we tend to focus the most on is which are the segments where you have the clearest right to wins having been determined, where you can predict with a fairly high degree of certainty, 6, 7, 8 years down the line, what the kind of market and competitive environment is likely to look like, who are going to be the winners, and what is the monetization capability. And I think within that framework, it's really kind of quick commerce, food delivery, vertical and horizontal commerce, and kind of the fintech. These are the spaces that we find the most attractive.
A bunch of names you've mentioned over there, Ashi. Kunal, a chat check on Paytm. It's done well, no doubt, but it's still about 16 to 17% lower from its IPO listing price. More run up only because of the fact that it's still not reached its IPO price, or do you believe that the rally that we've seen this year is good enough?
No, so I think I'll compare Paytm not just in terms of price, but in terms of the behavior. Because it's very, very essential to track that, because from those, I think 2000 odd levels or 1800 levels, which is the high for Paytm, I think from that kind of a zone, there was a point where when Paytm went to 450, 470 thereabouts, the stock was an extremely high beta name. Now you look at the last and in various market moves, when the indices used to move up higher, the stock used to participate in a much more high beta fashion, and then vice versa, when the markets used to go into a correction, the stock corrected far higher than the indices. But the last 6 months, 1 year broadly, we've seen a big change happening for this beta nature for the stock price. Now that essentially tells us that we are looking at a new trend emerging for Paytm, something which could be completely different than what it was maybe post the listing for the stock in 2021-22 odd period. So I think in that sense, yes, there should be more up move for Paytm. The fact that the stock is not very high beta, goes into a sideways range when the markets go into a phase of a correction, or when the sentiment becomes a little negative for the overall markets. And then when the markets manage to pick up pace, you see the stock getting back into a breakout. So that I think is an ideal quality for a stock which continues to, I would say, share positivity over the medium to long term. So bullish on Paytm at current levels, and in fact, in case if there is any kind of a mild consolidation, say a 5% to 10% kind of a drift into the stock price, that should be taken as an opportunity to average.
Okay, that's that on Paytm right now. The Nifty, of course, has slipped below the 26K mark. Let's see where we actually close the day. And the breadth, of course, has gotten a whole lot worse. 165 is the count to the red, but just about 48 to the green within the F&O universe. But actually, for the year ahead, what should be the right asset allocation mix? I know it's, literally person to person, and everyone would have a different, case and a cause. But largely, what would you recommend between small caps, large caps, silver, gold, realty, etc., and fixed income, of course?
Okay, sure. So that's actually, it's quite a wide question, right? So I think firstly, just sticking to equities, in the near term, we continue to kind of favor larger mid caps over kind of small caps. We believe you need much larger kind of economic and corporate earnings momentum before you start to see small caps starting to kind of participate. It's also important to understand that small caps have had a couple of very, very strong years, and arguably kind of valuations are a little more comfortable in large and larger mid caps as compared to smaller caps. So within kind of equities, at least in the near term, we would continue to favor large and mid caps. Our view is that equities should start to see a rebound going into the next year. So equity over kind of fixed income quite clearly. That said, this is obviously kind of, these are just larger calls. It will vary individual to individual in terms of what their specific requirements are. But as long as there is a longer term investment horizon where volatility of markets can be is not an issue, I think we clearly would recommend equities over kind of fixed income. Now, kind of the whole outlook on precious metals is really quite challenging. If these are kind of difficult to it's very difficult to kind of model what's going to happen in precious metal prices in the near term because there is no fundamental basis in which these can be valued. I think the one element to note is that these have had a very, very sharp run up. And what tend to be classical signs of coming close to the top of a bull cycle, where you have many, many retail investors starting to kind of jump in after a significant move has happened. You're seeing that kind of quite clearly. We would be quite cautious about precious metals. I think a large part of the run up has happened when you're actually now buying after the fact. So that is something we'd be a bit cautious about. Real estate, we are kind of positive longer term. We believe that pricing momentum should kind of be there. But a large part of the kind of pricing catch up that had to happen, it is important to understand 2010 to 2020, really nothing much happened in terms of real estate. So you've had a couple of years of fairly strong price improvements. We believe you're not likely to see price gains of that magnitude, but general positive sentiment around real estate prices should kind of sustain in our view. So broadly, if I had to kind of rank these, it would really be equity quite clearly up there, fixed income for people who have shorter term requirements and where there is a need to kind of protect capital, followed by kind of real estate and then lastly, precious metals.
Okay, that's the take right now coming in on, what kind of asset allocation one should have.